Valuations using Excel, Part 1, Lecture 17. Lecture Outline. Hello, welcome to Lecture 17 of Equity Master Secrets. This lecture is on valuations using Excel. And the first thing we're going to do is just briefly recap the different valuation methods that we've already learned so far. Then we'll move on to our case study, and we'll look at an example of valuation via liquidation value. And then we'll have an Excel discussion on this case study. So we'll actually go into an Excel sheet and look at the financial statements for a particular company and see how to value them. And after that, we'll talk about investing using the price to book value method. And we'll look at the next study, case study, which is on reproduction cost method. And after that, we'll conclude. So really the goal of this lecture is to, really get deeper into the whole valuation understanding by actually looking at some examples. So we'll look at some data of companies, and also look at the financial statements of a company. And by doing this, hopefully it should put you in a position where you can go out and do this yourself and value a company on your own. Okay, let's get started. Valuation methods recap. So the first thing we're going to do is just spend a little bit of time recapping the different valuation methods. And obviously, we've seen this over previous lectures, but it's just good to get a reminder because we're going to go into the Excel sheets and actually look at how we would do this in practice. So what have we done so far? Well, in the previous 3 lectures, we studied 3 different valuation methods. And these valuation methods that we've studied should ideally put us in a position where we can value any type of company that we want. Right? So across all the methods, you should be able to now value any type of company. We say almost because there always could be exceptions, but in general, this is a good metric to go by. And how do we classify the different types of companies when we're looking to value them? And typically our main measure was looking at the return on capital for the company over a long-term period. So we have 3 situations when looking at return on capital, and we're essentially looking at return on capital relative to the cost of capital for a company. And we covered valuation methods with all the 3 possibilities. So the first thing we looked at was valuing companies with return on capital less than their cost of capital. The second was valuing companies with return on capital equal to the cost of capital. And lastly, we looked at valuing companies with their return on capital greater than the cost of capital. So these 3 factors really do affect how you're going to value the company, right? Because we know that when a company has a return less than the cost of capital, their business operations are actually destroying value, right? Because the capital is costing more than what they're actually able to make a return on. And with the company that has a return on capital equal to the cost of capital, they essentially don't create any value through their operations, but they don't lose value either. And finally, when a company has a return on capital greater than the cost of capital, this typically means they're creating value over time, right? They're actually going to be adding to their capital base as they continue their operations. So these are the 3 different types of companies that we look at, right? We classify a company into one of these 3 categories. And then based on the category that it's in, we will actually value it using a particular method suited for that type of company. Valuation methods recap. So the first thing to note is that when we're trying to classify the different types of companies, the first 2 cases are fundamentally quite different from the third, right? So remember, in the first 2 cases, the return on capital is either less than the cost of capital or equal to the cost of capital. And only in the third case is the return on capital higher than the cost of capital. And what this implies is that growth in earnings does not add to intrinsic value in the first 2 cases. Right? So we said that in the first case, when their return on capital is less than the cost of capital, their operations actually destroy value. Right? So earnings growth actually destroys value. And in the second case as well, where the return and the cost of capital are the same, earnings growth doesn't create value for the company. Right? Because whatever they earn is offset exactly by their cost of capital. So it's really the third case that's the most interesting one. So in the last case, we see that growth in earnings does add to the intrinsic value, right? So then we need to consider new valuation methods, right? Then we need a way to take into account this growth in earnings when we're doing our valuation. Right, so then we discussed our third method of valuation, and this was the case where the return on capital exceeded the cost of capital and we also had growth in earnings. So now, as I said, we've looked through all the different methods, and the next goal is to really look at some examples of valuing companies. And what we'll see is that, the theory of sometimes of valuing companies is quite clean and quite straightforward, and when you actually get into valuing the company itself, things get a little bit more tricky, right? And that's why we do want to spend a bit of time going through this, because it's not always as simple as the theory implies, as a lot of the formulas we've gone through imply, but it's going to still follow a very similar format. So we'll look at the formulas that we derived before and apply them to these companies, and we'll actually see how to go through companies' balance sheets and financial statements in order to come up with the right valuation. Alright, so now let's move on to our case studies. Case study 1, asset-based valuation. So when do we use asset-based valuation? Well, asset-based valuation is most useful when a firm earns less than the cost of capital. Right? So if a firm is earning less than the cost of capital, it means that their operations are destroying value. So we don't want to consider their earnings, and we kind of just want to look at the asset-based value of the firm, right? So you can think of it as some measure of what the firm is worth based on their total assets. And we have two ways of approaching this. We have the liquidation value method and the reproduction cost method. So the liquidation value method works as follows. So suppose a company is trading at a significant discount to its book value, then we would deem that it is trading below its liquidation value. Right, so liquidation means that if you were to take this company and essentially sell off all the assets and pay off all the liabilities, and what would you have left, right? What is kind of the book value or the net total assets left after we do this? And that is the liquidation value of the firm. And when we value the company, if it's trading at a significant discount to its book value, right? So let's say the market price per share is significantly lower than the book value per share, then we would say it is trading at a discount and trading below its liquidation value. And as we said, this is because the book value is nothing but the difference between the total assets and the total liabilities of the company. So book value is what is left of the business after paying off all the liabilities. Right? So the key thing to remember about liquidation value and book value is that it does assume that we're actually taking all the assets and selling them. Right? So it's not always a realistic assumption, because you don't know if you can actually sell off all the assets. There may be costs associated with doing that, so we would need to take these into account. So a firm trading significantly below book value is said to be attractively priced, as the difference between the two is what an investor can earn if a liquidation is ever conducted. Right? So the book value is saying, well, what would you get if you were to liquidate the company? And it's important to keep in mind that liquidation, as we'll talk about, is not necessarily a straightforward process, right? It's a good way to think about valuation, thinking about the book value and the market price. But in practice, actually doing a liquidation may be quite costly, and we'll talk about that a little bit more. Case study 1, asset-based valuation. So hopefully by now you're thinking, well, what are the stocks out there that are earning less than their cost of capital right now and are trading below their book value? Right, so this means that what are the companies whereby we have return on capital less than the cost of capital? So we'd want to use an asset-based valuation method. And if we were interested in the liquidation value method, what are the companies where we're seeing their stocks trade at a significant discount to their book value? Well, we have an Excel sheet that lists down the companies from the BSE 500 universe that possess these attributes as of now. Okay, and this is as of January 2014. So we can look at this Excel sheet, which we'll do right after we finish this slide, and we'll see a long list of companies, and we'll look at what are their return on capital, and also what is their book value and their price to book ratio. And in creating the spreadsheet, we've taken the cost of capital to be 15%, and we've shortlisted those companies where the return on capital employed has been less than 15% in each of the last 3 years. Right, so we see that the firms are consistently earning below the cost of capital. And from a price to book value point of view, we've only included those stocks that are trading at a discount of more than 20% to their book values. Right, so this means that the price to book value ratio must be 0.8 or lower. Okay, and this is kind of related to the concept of margin of safety, is that whenever you're looking at these kinds of metrics, you don't necessarily want to a price to book ratio of 0.95 and say that that's trading at a significant discount to book value, because there's always some errors in these calculations, right? Especially the book value, you might have assets that are not valued correctly, or when you actually liquidate them, they get you different values than what you thought. So you have to have this kind of cushion, and we've kept it at 20% in order to really claim that this is a stock that's trading at a significant discount to its book value. Okay, so let's now go ahead and look at the Excel sheet, and we'll go through this list of companies, and we can see what kind of companies possess these attributes that we're talking about. Here we are in Excel, and what we have here is a list of companies that we've sorted by price to book value. So this is looking at the price per share relative to the book value per share, and in particular we've organized these companies based on a couple of categories. The first is return on capital employed under 15%, and the second is a book to value price to book value of under 0.8. So this is the entire list of stocks that are in the BSE universe, and you can see that we've started with the lowest price to book value, and we have a price to book value of 0.2 here, and we've gone all the way until up to 0.79, so just under 0.8. These prices are as of 13th January. So, obviously this would be a good starting point if you wanted to think about investing in companies that are trading at a significant discount to their book values. But one important point to keep in mind as well is that all of these companies have a return on capital that's less than the cost of capital. So we've assumed that the cost of capital is around 15%, and this is a fairly reasonable assumption, simply because we know, for example, that a fixed deposit on its own, which is risk-free, may pay between 8 and 10%. So it's reasonable to assume that we'd have an additional equity premium of around 5% or a little higher, right? So we think that 15% is the cost of capital, and all of these companies are earning less than the cost of capital, right? And what that means is that when you earn less than the cost of capital, it effectively means that you're destroying value on a year-to-year basis. So each year the return on invested capital is less than the cost of capital, and that's what causes the value of the company to decrease. So in that sense, you can kind of see why the market might value these companies at less than their book value, right? Because there may be some expectation that because of the fact that they're generating returns less than their cost of capital, that that we shouldn't necessarily value the companies at their book value. So that's one way to interpret why we have these low price to book values. And other things are as well that sometimes companies temporarily have issues, and this can cause their price to book value to go down. But if they're fundamentally strong companies, then then you're able to actually buy them at quite a bargain price, right? So as investors, we want to interpret this number by saying, well, here are the companies that are trading at less than their book values, right? So less than, for example, their liquidation value. And if we find companies like this which have actually strong revenues consistently, then possibly they're worth investing in, right? So it's not necessarily a good idea to just only look at the price to book value and say we're going to invest just based on that number. But it's certainly a good starting point, and it gives you a good indication of companies that are potential candidates for investments in, right? And so we've actually given the return on common equity, return on capital employed for 3 years, and in some cases it's very low. For example, this company here, Indiabulls Power Limited, has almost no return over the 3 years, and in most cases, you will see small numbers, right? So in this company here, Electro Steels, we have negative returns, and some of the companies do have large positive returns. For example, over here we have, Navily Lignite Corporation, which has returns that are fairly close to 15%, but still underneath the cost of capital. So you get a pretty wide variety of companies here, and this is all the companies that that as of this date have these criteria, whereby the return on capital is less than 50% and the price to book value is less than 0.8. Right, so in some sense, this is like a traditional definition of what a value stock is. Right, it's a stock that's trading at below its book value. So if you want to go ahead and start investing in these types of stocks, this is a good place to start. Right, we've compiled this list of companies, and then after a little bit more investigation into each of the companies, so for example, get a flavor of why it is that their market price is so low. Is it something fundamentally wrong, or is it something temporary that the company will likely get through in the future? Based on all these factors, you can make a decision, do I want to invest in these companies? And we'll spend a little bit of time talking about, what are the kind of optimal trading strategies or optimal investing strategies when it comes to, investing based on these statistical measures like price to book value, right? And we'll kind of see that a portfolio approach is usually the best way to go about it, rather than just doing single stocks. But we'll talk about that later. All right, let's go back now into the PowerPoint and carry on the lecture. Case Study 1, Asset-Based Valuation. So now we have had a chance to look at the Excel sheet, right? And we've seen that there are around 65 companies from the BSE 500 universe of stocks that are trading at a discount of more than 20% to their book value. And this is quite a large number, right? It means that 1 out of every stocks can be bought below its book value. And maybe you're thinking now, well, should an investor go ahead and buy all of these? And unfortunately, it's not as simple as that, right? We certainly don't believe that you should go ahead and buy a stock just because it's trading at a discount to its book value. And the reason for this is that one of the big assumptions that we made is that buying below book value means the stock is below its liquidation value, right? We've kind of essentially equated book value and liquidation value. And this could be a problem because in practice, not many companies actually liquidate, right? In India, liquidation is not very common, and the process is very cumbersome, right? Because liquidation typically means you're going through some kind of bankruptcy process, perhaps. There's a selling off of the assets, and there's other stakeholders like bondholders that get paid first, and then the residual goes to equity holders. So there's kind of a lot involved when it comes to actually liquidating a company, and then the assets getting split up. So the process is quite cumbersome, and for the companies that do get liquidated, we're not even sure how long this process takes, because as you know, this court system sometimes can be quite slow, and these things can take time. So we don't necessarily want to bank on the fact that a company would be able to realize its book value simply by a fairly straightforward liquidation. Okay, so that's one of the big assumptions we make, and that's one that we must keep in mind. Another important point is that the book value sometimes has historical values that are not completely accurate, and we kind of mentioned this earlier. So it's not necessarily again the case that it will be the same as the liquidation value, right? You might have, for example, some property on your balance sheet that you've listed at a particular value, but maybe the market now values that property lower. So when you actually liquidate it, you would get less for it, right? So these are kind of some of the issues with the asset-based valuation method using liquidation value. Investing using the price to book value method. So given all that we've said now about the problems with liquidation value, does that mean we should not go ahead and buy stocks below their book value? So that's absolutely not the case. You can certainly have a strategy, an investing strategy, whereby you buy stocks below their book value. And the reason we say those issues with those assumptions is that it just means that there's a possibility that your trade goes wrong, even if you're buying it below book value. But it may be the case for the majority of the companies that you'll actually make a good return, right? It's just that there is a risk involved in this type of strategy, which we just want to highlight. And there are still plenty of investors that swear by this method, right? So they tend to look at the book value as a main metric of valuing the company, and tend to put a lot of weights on balance sheets as compared to earnings, right? So remember, this type of valuation method only considers the balance sheet. We don't really consider earnings at all. And they use the price to book value method as a good starting point for investing in statistically cheap stocks. So by statistically cheap means by this type of metric, right? Price to book value. A low price to book value means it's cheap, right? So the price of the share is cheap relative to the book value per share. So how do we actually approach investing based on the price to book value method? So here we are of the view that investors should take a portfolio approach rather than a stock specific approach. And the reason we say this is that because there are risks associated to investing based on this method, and the best way to mitigate these risks, right, is to actually just have a portfolio and be diversified. That way, even if a few of those companies end up losing money, you end up losing money in those investments, even though they're trading at a discount to book value. If you have enough winners, that'll offset your losers, and you'll make money overall, right? So the best way to invest using the price to book value method is to take a portfolio approach and invest in multiple shares at the same time. Investing using the price to book value method. So how do we go about doing this in practice? So essentially, we looked at a list of stocks whereby the price to book value was less than 0.8, right? It's trading at more than a 20% discount to book value. And what you would want to do from there on is actually, maybe invest in a portfolio of around 25 to 30 stocks. And, try and obviously go through the financial statements of these stocks, look for companies that have consistently strong revenues, right? So companies that are consistently, making money, and evaluate the balance sheet strength of the company. So ensure that, the book value is accurate, right? Based on what we think it is. And from that list, you narrow it down to a list of 25 to 30 stocks and then create a portfolio of these stocks. The next thing that's also important is to have a definite buy and sell criteria, and stick to these criteria with a great degree of discipline, right? So you might want to think, well, if a company is trading at a price to book value of 0.7, maybe if the price to book value eventually becomes 1, right? So it's trading at book value, then you would sell the stock. And you might also sell the stock if you were to lose money. Let's say the price to book value would fall a lot as well. So if you're disciplined about this type of approach, studies have shown that this type of approach is capable of beating the market over the long run, right? Because essentially what we're doing is we're buying stocks that are cheaply priced, right? And in a financial market, we expect that cheaply priced stocks will have higher returns as compared to stocks that are expensive, right? So it's certainly a good approach, and one that can beat the market in the long run. Obviously, not all investors will be comfortable with this type of method, because we're not necessarily going into huge detail to each company. So in that situation, we'll look at now the next method of asset-based valuation, replacement cost method, and this is certainly a very good method, and we recommend using this as well. So we'll now go on to talk about that. Case study 2, reproduction cost method. So what is the replacement cost or reproduction cost? So we can define this as the value a firm's competitor would have to pay to replace it today at the currently most efficient way of production. What does this mean? Suppose we have a company, okay, and we're a competitor, and we wanted to essentially create this company from scratch, right? If we wanted to replace the company, let's say take everything the company had and replace it ourselves, spend whatever we need to create a copy of that company, this would be the replacement cost, right? And we can assume that we do this at the most efficient way of production. So another way to think about it is that it is the amount of money an investor or a business has to pay or lay out in order to acquire a competitor's assets or to replicate their assets, right? So we're saying if we were to create this business, how much would it cost us to do so? Or equivalently, if we want to buy this business, how much would it cost to do so? And those two should be the same thing. And when is this method particularly useful? Well, it's applicable whenever the industry is stable or growing, but the firm enjoys no or limited competitive advantage in the industry. So when we have no competitive advantage, it means that we have the return on capital equal to the cost of capital, okay? And it means that we don't really need to worry too much about earnings, because earnings growth doesn't add value to the company, right? It keeps the value the same because the cost of capital is the same as the return on capital. So this type of method tends to work well with mature industries, right? So a stable industry, usually one that's been around for a long time, and where growth is very stable, and the firm has no competitive advantage. And in that situation, the reproduction cost method is a useful one to use. Case study 2, reproduction cost method. So in a nutshell, what we're doing is that instead of looking at the book value, which is the liquidation value of the company, the replacement cost method calculates the value of the firm on a replacement cost basis, right? So how much would it cost me to actually, replicate all the competitors' assets or the company's assets? And once we get a value for this, right? So we'll actually do this exercise, and we'll come up with a number that says, the replacement cost value for the company is, X rupees per share, and then we would want to compare it with the current market value of the firm. And of course, whenever we're doing this type of exercise, we're looking for situations where the value of the firm, right, based on what we calculate from the financial statements, is significantly higher than the current market value of the firm, right? So based on the current price per share, that's at a significant discount to the value that we think it is, right? And that's obviously, in that situation, we would want to buy the shares because, it's trading at a discount to its value. So if we were to see the market value is at a significant discount to the replacement value, an investor can go ahead and invest in the stock. So keep in mind that it does need to be at a significant discount to replacement value. And again, this is the concept of margin of safety, right? Because when we do our valuation methods, it's never exact, right? We don't know the exact value of everything. There's a lot of estimates made. So to take into account the fact that our estimates are not always 100%, we leave some margin of safety between the market price per share and the replacement value that we think it is. And if the margin of safety is big enough, then we go ahead and invest in the stock. And margin of safety is something we're going to talk about later in this course, and we'll do it in a lot of detail. But it's a very important part of value investing. So now what we're going to do is look at a real life example of a company called JK Lakshmi Cement, and we have an Excel sheet with the financial statements of this company, and we'll go through this, and this should help you better understand this metric. So how to implement reproduction cost method, and we'll actually look at the financial statements and show you how to do that using a real life example. The final point we will also note is that this valuation exercise that we are about to see, this is purely from an academic point of view. This means that this example is purely constructed to learn about how to do valuation using the reproduction cost method. It must not be construed as a recommendation, so we'll go ahead and value this company, but please do not take that as that we are recommending to invest in this company. Okay, so let's now go into the Excel sheet and do the valuation. Here we are in Excel, and what we're going to do now is look at an example of replacement cost valuation. So we have a company, JK Lakshmi Cement, and we have here in the Excel sheet a variety of its financial information and some statements. So this is there's 3 different sheets here, so we'll go through each one in turn. The first one is going to look at their financial ratios of this company over the last 3 years. After that, we'll go through the company's balance sheet, the most recent one for fiscal year 2013. And then we'll also, after that, look at how to value this company based on all the information we have. So let's start by looking at the 3-year financial ratios. So we'll go through each line so we understand what's going on. So we have, this is from their financial statements for March 11, 12, and 13. So the first category is going to be operational and financial ratios. And first we have earnings per share. And we can see this has been going up consistently over the 3 years. Next we have adjusted earnings per share. And adjusted typically is adjusting for potential dilutions in the stock. In this case, the numbers are the same, so we don't really need to worry about that. So just think of this as earnings per share. And after that, we have the cash earnings per share. Next, we have the dividend per share, which is what the company will pay out to its shareholders based on the dividend that they pay. Then the adjusted dividend per share, for which there's no change. After that, we have the book value of the company, and this is just the value of its assets minus its liabilities, so the book value, and this has been growing over time. And then we also have the adjusted book value, which in this case is the same. The next important ratio is the price to book value ratio. So this is one we looked at earlier in this lecture, when we looked at a list of companies with price to book values of less than 0.8. So this company, JK Lakshmi Cement, would have met that criteria in 2011 and 2012, but not in 2013. The price to book value was close to 1 by 2013. Next we have the tax rate that the company pays. And this is a combination of rates because there might be different rates on different activities. So this kind of looks at the overall tax rate that the company pays, or the effective tax rate. After that, we have the dividend payout ratio. So this is looking at how much is the company paying out in dividends. And this has been falling over time. And this is even though the dividend per share, as you can see up here, has been growing over time. So this is kind of reflecting that the company's earnings have been growing significantly, right? And that's why the dividend payout ratio is falling, even though actual dividends are rising. So these are all the operational and financial ratios. The next set of ratios are the margin ratios. So the first one is going to be profit before interest, depreciation, and taxes margin, right? So this is kind of before we sort of deduct anything, and this has been rising, and it's relatively stable in 2012 and 2013, risen from 2011. The next one is the earnings before interest and taxes margin. So this is going to take away depreciation, and you can see that has a pretty big impact on the margins, right? They kind of fall quite significantly from the line 15 margins. So depreciation is obviously a big part of a big expense for this company, and that kind of makes sense because it's producing cement, so they have a lot of equipment which presumably needs to be replaced at regular intervals. Beyond that, we have the pre-tax margin. So this is going to take off interest costs, and this then we get a lower number again. And then once we take away taxes, we have the profit after tax margin. And lastly, in this category, we have the CPM, or the cash profit margin, which we can see here has also been rising over the last 3 years. Moving on, next we now have the performance ratios. So the first one is return on assets, and that's just going to be the company's profit after tax divided by its assets. Then we have return on equity. This has been also rising, as has return on assets. And then we have return on capital employed, and this is also rising and slightly lower than return on equity, except for in this year. The next we have is asset turnover, right? That's looking at the relationship between the total assets and revenue. Then we have inventory turnover, so that's looking at inventory and total revenue. And then likewise with debtor turnover and fixed asset turnover, and these numbers are all relatively stable over the 3 years. They're rising a little bit, and then we have sales to working capital, which is also rising, and we don't have a value for the final year. Moving on from that, we have the efficiency ratios. Okay, so this is kind of telling us, how well does the company run its operations. So we have the first is the fixed capital to sales ratio, and that's declining over the 3 years. We have the receivables days, right? So how many days of receivables does the company tend to have? So like how long does it take for a company to get paid the money that it's due? And this is pretty stable, around 7 days. Then we have inventory days. So how long does inventory stay with the company? And this has been declining. So that kind of indicates an improvement in efficiency. Then we have payables days, and this is stable around between 21 and 24. The next categories are the growth ratios. So here we have net sales growth. So we can see in 2011 net sales dropped by 11.5%, and they rebounded strongly in 2012, and also smaller but still strong growth in 2013. Then here we have growth in earnings before interest, taxes, depreciation, and amortization. And this also a big fall in the first year, 2011, with a recovery the following year, and still strong performance the year after that. Then earnings before interest and taxes growth, profit after tax growth, adjusted EPS growth. All of these follow a very similar pattern. A big fall in 2011, followed by a large recovery the following year, and then still strong performance, though less growth in 2013. And finally, the last set is financial stability ratios. So we have the total debt to equity, okay, the debt to equity ratio, and this has been stable around 1. So that kind of tells us the company has around an equal amount of debt and equity. And then we have these other ratios as well. So we have the current ratio, which is looking at current assets and liabilities. We have the quick ratio, which is another measure of current liquidity of the company. And these two have both been falling. So this kind of indicates this is slightly a bad thing. It means that the company's current or liquid assets are getting small. So that's not necessarily a good sign. And then we have the interest coverage ratio, and this has been improving. So that's a good thing. It means that the company is more easily able to meet its interest obligations. And finally, we have the debt to market capitalization ratio, which is measuring the total debt to market cap. And you can see here this has been falling, and that's presumably because the stock price has been rising over this time, so the market cap has been growing as well. Okay, so these are the 3-year financial ratios. We'll now move on to talk about the balance sheet. Fiscal year 2013 balance sheet. So now let's look at the balance sheet for the company. This is the most recent one as of fiscal year 2013, and this is measured in millions of rupees. So the first thing we're going to look at is equity and liabilities, and after that we'll look at assets. So the company's share capital, 589, and then we have the reserves and surplus of 12,002. So this gives us total shareholders funds of 12,591. Okay, so this is kind of the total value of the equity, right? Because this would be the assets minus the liabilities. So that's the equity. Let's now move on to liabilities, and we'll split this up into non-current and current liabilities. So non-current liabilities, we have long-term borrowings. This comprises most of it, and this is just essentially the debt of the company. We have deferred tax liabilities, other long-term liabilities, and then long-term provisions. And this gives us total non-current liabilities of 12,532. Then moving on to current liabilities, this also is fairly sizable. So the total amount is about half of what the non-current liabilities are. And this consists of short-term borrowings, trade payables, other current liabilities, which is most of it, and short-term provisions. And then we add together the non-current liabilities and the current liabilities to get the total liabilities. So that's at 18,839 in millions. So that's the first half of the balance sheet. Now let's look at the second part, which is going to be the assets. So first we'll look at non-current assets, which is the first category, and then current assets, which is the second one. So the non-current assets, first we start with fixed assets, and this consists of tangible assets, intangible assets, and capital work in progress. And then this gives us the total fixed assets of 21,236, which does comprise most of the total non-current assets. And as part of this, we have non-current investments, long-term loans and advances, and other non-current assets. And the sum of the total fixed assets plus these other ones here give us the total non-current assets. And this comprises most of the company's assets, and we can kind of expect that this would make sense because the company is producing cement, so it's going to have a large amount of fixed assets. So typically these tangible assets will be quite big. This would include the cost of their plants that they use to produce the cement, right? So this is going to be a big component for this company, given the nature of the business that it's in. Okay, so that gives us non-current assets, and now let's look at current assets, which is quite a bit smaller. So we have inventories, current investments. That's 3,700, and this comprises over half the total current assets. Then we have inventories at 1,148, which is again fairly sizable. And then we have a lot of other smaller elements that make up the current assets. This includes trade receivables, cash in bank balances, short-term loans and advances, and other current assets. And then we add that all together and we get total current assets. And the sum of total current assets and the total non-current assets will give us the total assets of 31,430. And this will be equal as well to the sum of the total liabilities plus the total shareholders' funds. Okay. So this is the balance sheet of the company, and this is obviously it's consolidated, so we don't necessarily have a lot of the details here of what comprises these things, but we're going to kind of base our valuation on what we have here, and we'll look at then how to value this company on using the replacement cost method. Alright, so let's now go on and look at the valuation. Valuation. So now let's move on to the main reason why we're doing this in the first place, which is valuation. So we've now had a chance to look at the financial ratios and the balance sheet of this company. So let's go ahead and look at how to value this company using the replacement cost method. So we'll just go through each of these lines. The first one is the cement capacity, and this is something that the company reports. So 5.3 million tons is the cement capacity of this company. The book value is what we had on the balance sheet, 12,591, and that's in millions. We have number of outstanding shares, also in millions, and then the book value per share is simply just the total book value divided by the number of outstanding shares. Next we have the share price, that's 78 per share. So that gives us the price to book value of 0.7, right? So we take the share price divided by the book value per share, and this gives us the price to book value. So the price to book value is 0.7, is less than 1, meaning that the company is trading below its book value. So that is one thing that we could say makes it a value company, a value stock. Then we have the debt to equity ratio, and that's the book value divided by the total debt. And they're almost the same, the total debt and the book value, which gives us debt to equity ratio of just under 1. We have the finance cost, which is reported by the company. We have the cost of debt, which is just the finance cost divided by the total debt, and this is 7.3%. And then we adjust this for tax as well, because interest is tax deductible. So the cost of debt adjusted for tax is 5.2%. The profit before tax, that again is from the company's financial statements. That'll be from their income statement. We have the current tax, which would also be from that income statement as well. And then the effective tax rate, which is the current tax divided by the profit before tax. Next we have the market capitalization, which is the number of outstanding shares times the share price. So this is kind of the market value of the company's equity as per the current market prices. Then we have the cash and cash equivalents. This comes from the balance sheet. And then we have this value, which is kind of the main one that we're interested in, the enterprise value. So the enterprise value is the market capitalization, that's B17, plus the total debt minus cash and cash equivalents. Okay, so if you remember, when we're looking at valuation on a replacement cost method, we're looking at the enterprise value compared to the asset value, right? And the asset value based on a replacement cost method, right? So if we see the enterprise value is below the replacement cost value, then we would want to take a position in the stock, right? We would say that the stock is undervalued. So this enterprise value is kind of what the market is effectively valuing this company as, right? So it's based on the market capitalization, so the market value of its equity and the market value of its debt minus its cash, and this gives us the enterprise value. And then this here gives us the enterprise value per ton. Okay, so we're taking the enterprise value, dividing it by the cement capacity, which is 5.3 million tons, and this gives us the enterprise value per ton. And this next line here, cement replacement cost, rupees per ton, 6,500. So this is basically the replacement cost of the cement company, right? So if we're looking at how much does it cost to actually replicate this per ton, it costs 6,500. Okay, and this is just as a number that we've come up with and has been used as an estimate of the cost of creating cement and creating the cement capacity. So the main metric we're going to use to do the valuation is looking at this enterprise value per ton and comparing it to the cement replacement cost per ton. So this last line here is the discount to replacement cost, which is essentially this divided by that minus 1, which gives us minus 52%. Right, so this means that the enterprise value is about 52% lower than the cement replacement cost, right, or about 1/2 the cement replacement cost. And these figures here tell us that this stock is essentially a good value stock, because what we're valuing the company at, right, on a per ton basis, is around half of what we think the replacement cost of this company is, right? So that's a pretty good discount to the replacement cost. Okay, so hopefully now you're in a good position where you understand how we do this type of valuation. So really a lot of these numbers come from the company's financial statements, and numbers like this one, this replacement costs, have to be estimated, and doing that we can then compare what we think what the market value of this company is versus what we think the replacement cost value is, and then we can invest if there is a significant enough discount. Okay, so let's now go back to the PowerPoint and conclude. Case study 2, reproduction cost method. So we've just now seen in the valuation in the Excel sheet that JK Lakshmi Cement is trading at about half the ballpark replacement cost of cement. So that may seem like it's quite low, but let's keep some important points in mind, which might give us a little bit more flavor as to why it is so low. So while the replacement cost is seen as a benchmark figure for valuing cement companies, the appropriate EV to ton differs from company to company. Okay, so if we're thinking about what is the right enterprise value per ton, this may depend on the company itself, and this would depend on fundamental factors such as geographical presence, distribution reach, management quality, operational efficiency, shareholders return, etc. So there are a variety of other things that can make the EV to ton not the same across companies, right? Some companies will have higher EV per tons and others will have lower. In the case of JK Lakshmi Cement, it is a small regional player. It has a debt to equity ratio greater than 1, right? So this means it has greater amount of debt as compared to equity. It also has profit margins substantially lower than its larger peers, and its return ratios that are close to or below the cost of capital. So it thus goes without saying that this company deserves to be valued at a discount to replacement cost. So what we mean by this is that given the financials of this company, we would actually expect that it should be valued at a discount to replacement cost. right? So it's not the case that we would expect the stock to rise to its replacement cost value, simply because there are a lot of other factors that we've discussed here that indicate that this company is actually not as good as it may first seem, and thus the true valuation is actually lower, perhaps lower than its replacement cost. And how do we get around this fact? Well, what we need to do is take into account the historical enterprise value to ton that the company has traded at to arrive at the fair EV to ton band, right? So if we're thinking about, well, what is the EV to ton band that we think is low enough that we would like to invest in this company, we need to first think about, well, what is the company traded at historically in terms of EV to ton? And if we can look at this historical EV to ton ratio, then we can kind of see, well, what is a normal range for this company, right? And then we can use that to arrive at what we think is the fair EV to ton band. Conclusion. So in conclusion, what we have now seen, we've seen real-life examples of asset-based valuation method for a firm, and we've looked at both the liquidation value, right? So looking at price-to-book ratios of companies and finding valuable companies using that measure, and also the replacement cost method of valuation. And one key point about the replacement cost method is that it will tend to work best when we have homogeneity of products between firms. So homogeneity means that firms are producing the same product. Okay, so we can think of this as being a commoditized product. So let's say a firm is selling cement, like this company. That's a commoditized product because one firm is selling cement and another firm selling cement would be selling the same thing, right? The cement should be the same. So there are lots of examples of companies where the product is not homogeneous. If you have two auto companies, they're both selling cars, but they're not exactly the same as one another, right? One might have some brand value, another might not. So the value could be different. However, in a business where the product is commoditized, like cement, we know that a competitor would sell it at the same value as anyone else. And that's why we can use the reproduction cost method, right? It means that if we wanted to replicate this business, we'd be able to do so because we can, replicate the product that they're selling as well. And as far as we're concerned, we tend to use this method only for the cement industry and to some extent for the hotel industry as well. So that's not a lot of industries because in practice, products do differ between competitors, right? As we gave in the example of the auto industry. But certainly for industries where we do have a homogeneous product between them or a commoditized product, then this type of method works quite well, right? So definitely for the cement industry, this is a method that we would use, and to some extent we also include it use it for the hotel industry as well, because their products tend to be homogeneous too. So these are two situations where we would use the replacement cost method of valuation. Conclusion. When we're looking at other sectors where there isn't any competitive advantage, like metals or basic materials, our preferred method of valuation is to use the price to book value method and use the historical bands to arrive at an entry and exit point for a stock. So what exactly does this mean? So suppose, for example, we were looking at a company, Tata Steel, okay, and we were valuing it using the price to book value method. And suppose that we observe that historically, Tata Steel has traded between 0.5 times and 0.8 on a price to book value basis, right? So if we plot the price to book ratio over time, we'll see that it lies in between these bands, 0.5 and 0.8. And then we would use these historical bands in order to actually invest in this company, right? So if the price went to 0.5 or below, then we would buy the stock. And once the price went up to 0.8, hopefully it does go up to 0.8, then we would sell the stock, right? And so we kind of use this type of method when we're looking at companies like metals which produce metals and basic materials, right? So the price to book value method, which we've already seen in this lecture, is pretty straightforward to use. It's quite easy to calculate the price to book value, and then we just look at the historical bands and then decide our entry and exit points accordingly. So this lecture, we've now covered a real-life valuation example on a company where we have no competitive advantage, and or where the return on capital is less than or equal to the cost of capital. Okay, and obviously we have other valuations that we want to look at, right? So the examples, for example, where the return on capital is greater than the cost of capital, we want to look at those examples too. So we'll carry on in the next lecture. In the next lecture, we'll continue to look at valuation examples. So we'll have more Excel sheets for you to look at. You should also be able to download the Excel sheets. That way you can, look at them in more detail at your own pace, and understand how it works and how we come up with valuations from that Excel sheet. Okay, so this concludes this lecture, and thank you very much for listening, and we'll see you next time.